All right. So this is what is there in the course, of which I've already talked about it. So we have said that in the first unit, we just define what financial accounting is, and we'll show you how to record these transactions and balance of the accounts. That's what we do within this
Okay.
conversation. Yes. So this is what we want to discuss. Yeah. Other things may not really be necessary for me to talk about. Yeah, you've seen the outline of the assessments, right? So you have the midterm assessment, okay,
Yes.
where you have 10 multiple choice questions. Yeah, adding up to 2 marks, to 10 10 multiple choice questions, 30 marks, 30%, of course. They will come from the trial balance, you get.
Okay.
Yes. Then somewhere in week 7, you have time to confirm the dates of an exam. Then the exam now, section A is on financial statements. Then section B is on financial ratios and analysis. That's all. Okay?
Yes, sir.
Yeah. So now, what is the accounting? Let's go through one more time. Yeah. It may sound boring. You are used to very hard things, but it's okay. It will get there. It will be more interesting as we move on, right?
Yeah.
Accounting is the process of identifying, measuring, recording, and communicating financial information about an entity to allow informed decisions and judgment by users of the same information. You get it, right? So you are there to identify. Now, let's try to do just a little bit of analysis of the definition. Why do we need to identify? Okay, it's because not every transaction, okay, not every transaction fits to go into the accounting books, into our books. There are some of the happenings, some of the activities that actually may not manage to go direct into our into our books. Is that clear? That's why we have to identify what is suitable, because we only record only business transactions. They're the ones that support to go into our books. Why do we need to measure? All the activities are expressed in monetary terms. Is that clear? All activities are expressed in monetary terms. For example, if you remember, there is an aspect of us talking about, what's that? There is an aspect of us talking about the depreciation of non-current assets. Just to maybe remind you, we said that the assets, the non-current assets, lose value as time goes on, isn't it?
Yeah.
That is to say, they depreciate. So now the depreciation, we just know that is some value, but we need to assign some monetary value to it for us to be able to quickly measure. You get the point? Just some notional cost that exists in our head, some notional expense. We just know that, okay, there is such an expense, but really that we don't really, it's not tangible. We are not aware. We don't even have evidence whatsoever, but we just believe it's there. So what you do, we assign some value. That's the message I'm communicating. We assign some measurement in terms of monetary terms. And of course, you have to communicate. This is where financial reporting comes in now. When you summarize this information, you record, you identify, you do everything, you keep the books, you need to communicate it to the financial users. And the key words is that, why are you communicating? So that the informed decisions, okay, and judgments can be made by those who use this information. Why? Because this, you should keep it in mind that from the very beginning, as you are doing accounting, since you're also going to do ACCA, like your major thing is to make sure that the information that you report is relevant to the people that you're reporting to. And you try to give as much detail as possible so that the informed decision can do what? Can come out. So this is a very strong point that you are allowing informed decision. So you are trying by all the means to be as clear as possible in your reporting or in your statements as you are writing, so that those people who, because the people to whom you are reporting this information, they were not there when transactions occurred. You get the point?
Yes, sir.
They are not usually there, so they have to just follow and see what you're writing and then believe that what you have said, it is right. Is that clear?
Yes, sir.
So that is what usually happens. Then let's have time to look at the major objectives. Of course, we said we are recording the transaction, we're preparing, and yeah. So now, we start with the celebrated accounting equation. This one is not very new to you. Yeah, you know that assets, it should always equal owner's what? Owner's interest plus liabilities, isn't it? I'm trying to use the language that you're conversant with, that we used last time. Capital, anyway, capital is same as the owner's interest, isn't it? Yes. So we are aware that this equation must always do what? Must always balance. So now, what is happening here? There are always two accounts that are affected, okay? Yeah. Though the equation is always in balance because there are two accounts that are always what? Affected. And one account will sit on the debit side and one will sit on the credit side. You get the point?
Okay.
Yeah. So that's what happens. Yeah. There is the other one that will sit on the debit side, then the other one will sit on the credit side, and they all have some effect on the general equation. For example, if the owner pays, are you able to see what happens? What is happening on the diagram? Or on the figure here?
Yeah.
Yeah. If the owner pays capital into the bank, right? You pay capital into the bank. What is happening to our bank account? Our bank account is receiving cash, right? Which is an asset. Is that clear?
Yes, sir.
Yes. It is receiving cash, which is actually an asset. And then when you go to what is going to happen is that these same assets that we are talking about, once they have increased, then that will increase our capital, okay, because they are adding into that as capital.
Okay.
Exactly. So that is what happens. They are adding into this as what? As capital. Then of course there is the issue of buying inventory by check. They have to do what? To buy inventory. For example, you buy inventory by check. What do you think is happening to the assets?
If you buy inventory by check,
Yes.
the asset will still increase because there's inventory.
Yes.
But then the capital, it will decrease.
Okay.
Because you are removing money. But again, it also depends when the receiver will deposit the check into the bank. So I'm not really sure.
No, right. You are okay. Yeah, you're in the right direction. So inventory is an asset. So we have accumulated the assets, right?
Yeah.
The assets have been increased, but at the same time, we have used a check. Remember, a check is an asset as well, isn't it? It's part of the asset.
Yeah,
Like it's cash. It will move cash from the bank.
Yeah.
So we are moving the same value. See, you've seen the effect. We are moving the same value.
Okay.
Have you seen the effect? We are moving the same value. Like when you move capital, like the same amount of let's say when you move your cash, we draw a check of that amount. You buy the inventories of that amount, isn't it?
Yeah, so it will be balanced.
It will still be balanced. That's a message. The message is that the equation is always just balanced.
But
You get
wouldn't
the
the
point?
capital decrease?
What would happen to the capital? How do you is a check part of capital?
No, it's part of an asset.
Right. You've seen what is happening, right?
So nothing will happen to the capital. Everything will just be happening to the asset. So,
Mhm.
but then at the same time, inventory will go up and cash asset will go down,
Exactly.
right?
Yes.
So which one are we going to like record?
The assets the inventories will go up, and at the same time the cash assets, like which is our check, the money in the bank, will do what? Will have to decrease. But unless we attach that, follow nicely, we attach that there was no trading here. Let's say
Okay.
let's assume there was no trading here. This money is the same money that we deposited in the bank.
Okay.
Remember, the owner paid cash into the bank, right?
Uh-huh.
Yeah. Now that the owner paid cash into the what? Into the bank.
Okay.
So we are using the same cash, right? We're
Uh-huh.
using the same cash that we deposited into the bank, which is the part of our capital, right? So
Yeah.
capital has decreased.
Okay.
Have you seen? Unless it was that case where we have where we are trading as well, we are also increasing our money. We are buying, we are selling, isn't it? We are parking money in the bank. But
Yeah.
this time around, we want to, the assumption that we have to put, there is no transaction that has occurred here. Like, how should I say? There is no extra cash that we have gotten here. We are still on the first transaction. We have cash in the bank. Then we use the same cash, which is part of capital, of course, to buy the inventory. Inventories have gone up. You've seen what is
Okay.
happening?
Mhm.
Yes. Yeah. So now let's see what happens if you buy inventory on time. What does it mean to buy inventory on time?
Like buying it when you need it to like make your products.
Okay. Buying inventory right on time. You oh yeah, just on time. I get it.
Just in time, yeah.
Oh yeah, I see. Okay. When you move on in the lecture, I will show you the meaning, like what we mean when we say buy on time, buy at time. Okay. Yeah.
Okay.
Yes. So that simply means that when you buy on time, it simply means that you are buying so that you can pay later. It's more like you're buying on credits. You get the point. Yeah.
Oh,
Like you're
I'm
buying.
buying on credit.
Yes. Yeah. You'll see as we move on within the lecture. You're buying so that you can pay later. You're not buying on cash, using cash. Okay.
Okay.
Mm. So, anyways, this is a part of the examples. If you sold the asset, sale of inventory on time, now you sell the inventory on time, what will happen?
They are buying on credit, the buyer.
Then you sell the inventories on what? On time. To sell inventories on time, you sell on credit.
Credit, yeah, sale on credit.
You have received
Basically the buyer will buy it on credit, yeah?
it.
Yeah.
So what will that do to our assets? Our assets will decrease, isn't it?
Yep.
Because we are selling the inventories.
And our what is it? What is that? Trade receivables, which is a liability, will increase.
Yeah. So we'll have the trade receivables on the other hand, but we have the inventories have gone up, have gone down, like we have sold them. Okay.
Yeah.
So we just have the trade receivables, which is basically an asset as well. You get the point?
Oh, it's an asset as well. Yeah, sorry, I'm so sorry. Not a liability.
Yeah, no, it's okay. It's an asset.
An asset, yeah.
Yeah, but let me just explain that the key message that we should get from here is that the message that is being communicated is that there are always two accounts. I think that's the summary of everything, so that we don't confuse everything. The summary is there are always two accounts that are involved in each each transaction. You get, that's a take-home message.
Okay.
Yes, we'll have more of such examples as we just move on down. So yeah, let's go on recording the transactions. We see how we record the transactions. Okay. Now you pay attention.
All right.
Number one, if there is no item exchanged, there is no transaction.
Okay.
You got it? If there is no item exchanged, then there is no transaction. And actually, what we have here is that we are weighing the transactions. Remember, we have the transactions here. We're dealing with the transactions. We are recording transactions.
Okay.
Yes. So there should be the aspect of us buying or selling. That's the message.
Okay. So if there's no buying or selling, there's no transaction.
There's no transaction.
Okay.
So in other words, there should be two parties involved for it to be called a transaction.
Okay.
Yeah. For example, there is that time where somebody asks for the price but does not buy the asset. If they ask for the price and they have not bought it, there is no transaction that has occurred, no exchange.
Okay.
But again, we can still ask for the price and buy the asset, which is the transaction now. Now, the form of settlement.
Price and they buy it, it's a transaction, eh?
Yes.
Okay.
How do you settle now? The form of settlements have to be analyzed critically. You can settle using cash, right? You can still settle using credit. Like there are those credit settlements, pay later. You get, right? Yeah. And then you can still use the capital, which is the money that you have. For example, if you buy a computer with cash, the item that has been exchanged is what? It's a computer, isn't it? And then the form of settlement, since you are buying with cash, it is called what? Cash. Is that clear?
Yeah.
Then if you pay electricity bills with the credit, then the item exchanged is what? Electricity, isn't it? Then the form of settlement is what? Is credit.
Okay.
You were buying on credit. You understand? You sell sandwich with what? With cash. The item, you see, sandwich. But the settlement is what? Is cash. Okay. You receive interest from the bank for money deposited. The item is the interest, which is the financial income. And the form of settlement is using the bank. So in other words, let me just summarize everything. We are trying to say there should be an item. Like you are paying for something, you get. You are paying for something and you are receiving because you have given something. So in short, this is the definition of a transaction. Give me, I give you. That's the point. Is that clear?
Yes, sir.
It's about give me so that I do what? See? I give you as well.
Okay.
Right. So now, if you want to record, for example, you buy a computer with cash, you have to create an account that we call a cash account. That is called a nominal account. You have a cash account where you're going to record your cash that has been what? Reduced.
Okay.
The cash account is here. Then you have the computer account again. Since there are two accounts that are involved, okay?
Okay.
The computer account is receiving. You have bought a computer, so it has received. Of course, you bought with cash. Your cash account what? Gave. Is that clear?
Yeah.
So that is what is there. So the key message here is that always debit the receiving account and credit the what? The giving account. Those are principles. Did you get it?
Yes, sir.
Debit the receiving account.
Debit.
Yes. The receiving account.
The receiving account.
And the credit the giving account.
And credit will be
the giving account.
Account. Okay.
We are good?
Yes, sir.
So the entry of the item exchanged is always the opposite to the entry of the form of settlement. I'll explain what that means. What it simply means is that, let me pick an example. You are having, let's say you bought a computer. You buy a computer using cash, 100, right? Let's say you have used the cash $100, buy an asset, okay? So what is happening here is that you have the cash account where because you have used the cash. So you will open the cash account, right?
Yeah.
You're following? Then the cash account in this case, since you are buying, okay? The cash account is what? Is in need of what? Is giving. It is giving this time around.
Okay.
Yeah. So now that the cash account is giving, what do? You have to credit the cash account.
Yeah.
With which account? It is giving to which account? To the computers you get. So the computer account will be the receiving account, and the receiving account is the one that you put under details. Then you write the amount here. You're following? So it showed that this is an indication that cash account gave to which account. That will be the details. Remember, when you're entering into the account, there is date. Of course, for those transactions that have got dates, there's a date. There are details or particulars, right? Okay. And from then the particulars, you have got the folio. I'll show you how you do that. Don't worry. There is that thing where when you have taught too much the course, you go beyond, like you go before the slides and everything. But I'm hoping you're not getting confused.
No, sir. So
exactly. So like the details will be the other account. Similarly, in the same transaction, let's see how this will sit in the computer account. Okay. So we'll ask ourselves, what is happening with the computer account? We have bought the computers. It is receiving, isn't it? We are receiving a computer, so the computing account is receiving, right?
The computer account is receiving.
Yes, it's receiving a computer. Like, Remember, a computer account is an account that you open where you record all your computers as a company. You have computers, then whenever you buy a computer, you record in that account. You get the point. Any transaction involving your computers, you record in that account. That's called your computer account.
Okay.
You get the point.
Yes.
The computer is for the business, of course. So now what is happening to this computer account or the account where you record all the computer things? It is receiving a computer, right?
Mm-hmm.
Now this computer, we bought it using what?
Okay. We bought it using cash, huh?
Yes, so the details will be cash. So it is receiving from cash account, 100. You get the point?
Yeah.
So like you're recording, the details will be the other accounts. Okay, when you're looking at this account, let's say you're looking at computer account. If it is receiving, you ask yourself, it's receiving from which account? Remember, there are just two accounts.
Okay.
Obviously, if you are dealing with this account and this account is receiving, it should be receiving from the opposite account, right? So that is what is happening. Is that clear?
Yeah.
Any question?
No, not really.
Okay. I'm hoping that you are understanding the way how I'm trying to summarize it.
Yes, I'm understanding a bit.
Yes, ask me a question. Why are you understanding a bit?
No, it's just a bit confusing for now. I don't know, like I understand the receiving and the giving, the debit and the
Don't
credit.
worry. Don't worry. You will understand before this lecture ends. I will make it very clear. Yeah, it's only that I'm starting that concept. I'm just opening it for you. Like it will be very deep as I go on. You understand. Don't worry. I've specialized in summarizing and simplifying issues. You know that. So the key message here I'm repeating is that the double entry rule is that there is always a giving account and a receiving account. Now, let's have this example. The owner of a new business has invested 10,000 pounds in cash in the business on 1st August 2019. Let's identify the two accounts because that's the major thing that you do here. To identify the key accounts involved in the transaction. That's the first step. Which two accounts do we have involved here?
Which two accounts? The cash account?
Yes.
And the I'm not sure. The business?
The capital account.
Yeah, the capital account.
Yeah, you are investing into the business, so the capital account. Okay. Now, let me, before I go any further, so that you are not confused, I have to teach this course like someone who has specialized in simplifying issues. Let me a little bit comment on some few major accounts, nominal accounts that you always meet most of the times in most of these transactions, so that as you are communicating, you are aware. Right now. Number one, you have got what is called the cash account. All the transactions that involve cash, they are recorded, they appear in the cash account. As long as the transaction is involving cash, it should be reflected in the what? The cash account. Are we good?
Yeah.
Number two, we have the bank account for the business. These are accounts that belong to the business. Now, the bank account, this is where you record all the transactions that involve the bank, right? All the transactions involving the what? The bank. Is that clear?
Yeah.
Yes. For example, you buy, on credit, you do what? On what? Just that. If you buy using a check, sorry, you issue a check, okay? If you issue a check or you receive a check, such transactions are recorded.
Okay.
Yes, they're recorded in the bank because they involve the bank. Any question?
No, sir, I understand.
Are you okay?
Yeah.
All right. Okay, let's go ahead. The second account. Hello?
These are the only two accounts.
No, we are going on, like we are continuing.
Oh, okay.
So we have the third account. The third account is called the capital account.
Capital accounts.
Yes, the capital, when you receive capital and what you record in there. Then we also have got another account that is called the receivables. Receivables what? Account. This is where you record the transactions that involve you selling on what? On credit. If you as the business, okay, as the business, you sell on credit, then you debit your receivables account. You have sold on credit.
Okay.
Every transactions that they don't go in cash account because you have not sold on cash. You get, so you record this transaction you in the receivables account. Is that clear?
Mm-hmm.
Now, if you buy on credit, you have to open the payables account. Your payables account will be debited if you buy on credit.
Okay.
Yes. Your payables account has to be debited because you have bought on what? On credit. Is that clear?
Yes, sir.
This is buying on credit, like buying on credit. This is selling on what? On credit. Are we good up to here?
Yes, sir.
You also have another account which is called the withdrawals account. This is where you withdraw the money from the business for personal use. So you debit this account every time you draw money from the, for personal account. If you withdraw cash, you debit this account, the withdrawals account, okay?
Mm-hmm.
And then you credit the cash account. You got it?
Yeah.
Yes. You credit the cash account because your cash account, your business cash account, is giving money to who? To you, the withdraw. Okay?
Yeah.
We good?
Mm-hmm.
And then we have the expenses accounts. Where you record all the expenses. You get, like now, listen carefully. The expenses accounts are categorized according to their names. Okay? Like whatever the name of the expense, that will be an account. This is very important.
Okay.
So for example, if you have paid for rent, you have what is known as the rent account.
Okay.
Okay. If you have paid the salaries, you have the salaries account. These are the accounts that appear even when you go to the trial balance, the expenses account. Everything that you list there under expenses, those are accounts.
Okay.
But you know how they come up with those, right? Do you know how they come up with those salaries account? Because you find just one figure on the trial balance. You know what happens?
What?
What happens is that every day they were recording the transactions, and because usually they prepare those figures at the end of the year. So they summarize everything, then they just balance off that T account, and then that total, only the total figure that they spent on wages or on salaries is what appears there. Okay? So usually even for those rentals, they just give you the total. So what is happening is that all expenses, right? The name of the expense shall be called an account. Is that clear? Okay. That's why you have depreciations account, because it's an expense. Okay? So all expenses accounts. Is that clear? And all incomes accounts, such as rent received. If you receive rent, you record that. Okay? Commissions received, those are incomes received accounts. You record them. And then you will have the personal account generally. So basically, these are the major types. These are major common accounts that you usually meet. Or there is also the purchases account. Sorry, I forgot. The purchases account where you buy things for resale. These are the major accounts that you will meet in these transactions. Is that clear?
Yes.
So whenever you just look at this account, very clear, this transaction, you will identify only 2 accounts involved in each of these transactions. I've told you, if you sell on credit, then you have the sales account involved and the receivables account. If you buy on credit, you have the purchases account involved and the payables account, isn't it? The purchase, if you buy on credit, you know what happens? When you buy on credit.
When I buy on credit?
Yes, if you buy on credit, then you have your payables account here. Okay, then you receive the goods. You receive those purchases. Those are purchases. Okay.
Okay.
Yes. So that is what is happening.
Okay.
Is that clear? Okay. If that is clear, then we are good. So if you have known these accounts, then we are good. Don't worry, we are reaching closer to the end. That's the major thing that you needed to take now. As for now, then we can a bit move on, unless you have a question.
No, sir.
Okay. Here is now the way how to record the transaction. Have you seen what happened? What is happening with the figure? So the owner of a business has invested 10,000 in cash in the business on 1st August 2019. So the owner of the business is investing cash. So the question is, what is happening to the cash account? You have invested, you have identified 2 accounts, you remember? You identified cash account and capital account. So when you open, for example, the cash account, ask yourself, what is it that is happening to the cash account? Okay? On this day. Is the cash account receiving or giving? Okay? That's the most important question. Number 1, identify the 2 accounts. Then when you open the account, for example, is the cash account, ask yourself, what is happening to the cash account? Is it receiving or giving? Okay. If it is receiving, for example, you have received the cash, then you will debit the what? The cash account. What details are you going to record? You know, there is date here. These are details. This is the amount. Are you following? So what do you write under details? Is the name of the other account the giving account? Remember, in each transaction, there is a receiving account and a giving account, isn't it? So in this case, our cash account is receiving. From which account? from capital account. Is that clear? Now, the same transaction, when you go to the capital account, how do you record it? The capital account is giving, right?
Yes, sir.
It is giving to which account? To the cash account, because it's receiving cash. It's giving cash. So cash account is receiving the same amount. So have you seen now? There is debit and what? And credit. So what is happening, even when you balance off your trial balance, all the transaction, the balances that are on the credit side, they will total up down. And those that are on the debit, they will total up down. They need to balance. Why? Because each transaction, it will appear both sides, on the credit and on the debit side. That's why it should balance. Is that clear?
Yes,
First
sir.
of all, don't worry, we'll get there. This is just the beginning. Yeah. It's just the start. So basically, we have the second example. A van is bought for what? For £4,500 cash on 2nd February 2019. We have identified the accounts that are involved here. We are buying a what? A van. Okay. Now, a van is an asset. So these are assets accounts. So all the assets, by the way, I didn't put the assets account. I just put expenses and incomes. They are also assets accounts. There you have to record them. So van is an asset. So I have to write van and cash. Because you paid using what? Cash.
Yeah.
In the same transaction, we ask ourselves, what happened to the, we bought a van? Yes. So what happened? Remember, there was already the transaction on the 1st. This is on the 2nd, okay? On the 1st August, our cash account had what? It had the capital. It received the capital of 10,000, isn't it?
Yes.
Previously. Now, the cash account is what? Giving. Are you following? So in short, ignore this part a bit for a start, as for now. Let's just ask ourselves, what is happening to the cash account? Because this part was in the previous exam. Let's ignore it a bit and concentrate on the other.
Okay.
Yes. What is happening to the cash account? Our cash account, is it giving or receiving?
It's giving and receiving.
Yes,
like,
let's check what
you're getting the van, but at the same time, you're also giving your cash.
Yes. So yeah. So what is happening with the cash? Is the cash account, okay, in other words, are we receiving cash as a business or we are giving cash?
We are giving cash.
As a business, we are giving cash, which means the cash account is giving. To which account? To the van account, isn't it? Like the receiving account is the opposite account. That's what I said.
Oh, so the cash will then go to the van account's debit.
Exactly.
Basically.
Yeah.
Debit account.
Yes. So now when you go to the van account, since you created the cash account, the van account will be debited because you have received what? You have received the van using cash. You get the point? Yeah. So this is what is happening. Are we good?
Yes, sir.
Okay. On the 3rd, there is a fixtures that are bought on time. This is very interesting. The fixtures that are bought on time and from shop fitters for 1,250. Number one, we have the fixtures that have been bought on what? On time. So what is happening with the fixtures account? Let's start with the fixtures account. The fixtures account have been bought on what? On time, which means the fixtures account. Remember, the fixtures are assets, right? These are non-current assets.
Yeah,
They
they've
are
been bought on
non-current.
credit.
Hello?
They've been bought on credit.
Yes. So what is happening to the fixtures account? Is it receiving or giving?
The fixtures account is receiving.
Yes, it is receiving. Okay. It is receiving. Yeah. This amount from this, but it has been bought on what? On time. On
Yeah.
time from the shop fitters. That's why now this is a personal account for the shop fitters. These are not really, this is not really a nominal account. So this one, the shop fitters have given the fixtures. Okay. They have given the fixtures, isn't it? We have bought from them. So if you start with them, you open their account, and they are giving, so you credit their account. Is that right?
Yes, sir.
Now, here is the message that you should take home. Here is the take-home message. Okay. When on *1, like here, when you buy on time, when something is bought or sold on time, it means that it will be paid for later.
Okay.
You get that point now?
We paid later.
Yes, I'm reading here. Are you seeing the slide? When something is bought or sold on time, it means that it will be paid for later. Okay. Now, the on-time transaction should be recorded in the personal what? In the personal accounts, meaning you are involving the names of the people that are involved. Those are personal accounts, isn't it? The names of the people or the names of their companies. Like names of institutions, those are personal accounts. You know that, right?
Okay.
Let me speak like this. You know what I like about my lectures? They're always very compounded. They have a lot of information in one. Listen carefully. Let me a little bit remind you or run you through the 3 different types of accounts that we have. Okay?
Okay.
There are 3 types of the accounts that we usually have. But those ones I listed, they are not really types of accounts. Those are, how should I say, the classes of the nominal accounts. Okay? Those are the nominal accounts, the T accounts that usually the business has. Now, these same classes, those classes are grouped into the following classes. They are the following major classes of the accounts. There are 3. Number 1, you have what you call personal what? Personal accounts. Okay. What are personal accounts? These are accounts where you record that involve the names of the people. You get, right? Names of people. Okay. So from the names of people, names of the institutions and organizations. You get, huh?
Yeah.
So as long as the account is bearing the name of the company or the name of the individual or the name of what, that account is said to be what?
Personal account.
To be a personal account.
Yeah.
Yes, sir. Is that clear? Yeah, we will. Now let's move on. Oh, I don't have to move on. I've just talked about the personal accounts. Okay. Personal what? Personal accounts. Then the other group of accounts is called impersonal accounts. Okay. Now the impersonal accounts are broken down into 2. Okay. We have the real accounts and the nominal accounts. You get the real account and the nominal accounts.
Mm-hmm.
What do you record in the real accounts? This is an account for assets. It is the assets account. So just to know that for example, the van account, the fixtures account, these are real accounts, okay? Because they are the names of assets. Cash account is a real account because it's an asset. Is that right?
Yeah.
Yes. I don't know if you are following really. Are you able to get me?
Yes, I'm following. I'm writing down.
Okay, great. We have the other account, which is called the nominal account. The nominal account.
Mm-hmm.
Yes. What do you write in the nominal account? These are accounts that involves profit and loss. So these are accounts that you find in the profit and loss. What are the accounts that involve the profit and loss? The revenue related accounts, or no, revenues, which are more like the sales, okay, sales account. You can't say the sales is a personal account. So
Okay.
like in short, all those accounts that are there in the profit and loss account. You get, right? Such as revenue, sales, expenses, okay? Expenses, incomes, okay? So the incomes account, the expenses accounts, and the sales or revenue goes in the nominal accounts, including capital. Is that right?
Yes, sir.
Okay. At least now you have understood, isn't it?
Mm-hmm.
So when I talk about the class of accounts, this is what I mean. So I wanted you to understand what they meant when they said the on-time transaction will be recorded into personal accounts. Now you understand what personal accounts means, right? For the names of the institutions and the names of people, those are personal accounts. We are good?
Yes, sir.
The real accounts for assets. Okay. We paid the amount owing to shop fitters in cash. Now remember we are owing that one because we bought on time. Some interesting language, eh? We want to buy on time. Someone may get confused who has not been to the school of business. Say, oh, you want to buy on time? Okay. But what we mean is that we're buying on credit. Remember last time we bought on time. Now we are paying the amount that we are owing these people. Now, these are confusing things in an exam, okay? These are confusing statements. You get the point? Because they will tell you that, okay, it was bought on time. You will not understand that there is a credit transaction here that is involved. You understand? You start involving the cash account. You start involving the cash account, but there was no cash that flew there. Okay. So basically, this is what is happening to such accounts. So now this time around, we are paying to them. So our cash account is giving, okay, to the shop fitters account. And the shop fitters account is now receiving the cash from us, from the, the shop fitters is receiving cash, isn't it? Because we bought them, yeah. Do we have any questions?
No, sir.
Yeah. Right. So now this is basically the same thing that I have been talking about. So what is the mystery of double entry? If you focus on the form of settlement, remember, is it cash involved? Is it what? Is it buying on credit? And then you will always get it right time again and again.
Okay.
Yes. So now the message is, how can we get some information from the T accounts? How is it possible to get some information from the T accounts? These T accounts, they need to be balanced off. If you remember when I introduced the course, I think we have moved a bit at an interesting speed. You remember when I listed these things, they sounded a lot, right? We have already reached on balancing of the accounts. We already, yeah. Yeah, but we will cement our understanding by doing the questions. So you will be fine. I wanted you to pick an idea. What does it mean to balance of the accounts? Remember I said those accounts, you are going to be inserting some figures, right? You are entering some transactions. Then at the end of it all, you have to close the accounts. Okay. For example, there was a personal account for Sealy. So he had all these records, both on the debit side and on the credit side. Now listen to what happened. The first thing that you do when you're balancing off the account, number one, is to tot up the debit side and the credit side, like sum it up.
Okay. All of the debit and all of the credit.
Yes, add everything. No, like add this side, you find the amount on the debit, the total on the debit.
Oh, okay.
Also add on the credit, find the totals for the debit ones.
Yeah.
Those are the steps that are involved when you are balancing of the accounts. Let me write them down so that you may not forget. Number one, total, the debit side as well as the credit side. You wrote that one?
Just a minute.
For easy remembrance, because when you're talking like this, you may think you have heard and you'll be able to remember, but after some time, you may not manage to remember.
The total,
the debit side.
The debit side as well as the credit side.
Exactly. Total the debit side.
Okay.
Total the debit side as well as the credit side.
As well as the credit side, yeah. Okay.
When you're done totaling, you're done adding up, and then number two, record the bigger amount on both sides. Okay.
Okay.
Yeah. Record the bigger amount on both side. Like the bigger amount should be credited and the bigger amount should be what? Should be debited. Exactly. The bigger amount to be credited and the bigger amount to be debited. Yeah. Right. Then when you do that, number three, what do you need to do? Subtract smaller amount. Subtract the smaller amount from what? From the bigger amount. You got it? Yeah. When you take the difference Number 4, record the difference. Okay, record the difference. Record the difference as balance carried down on the smaller amount side. On the smaller amount side. You can finish up with that. So record the difference as what? Balance carried down.
Balance carried down.
On the smaller side. It is usually recorded on the smaller side.
On the smaller side.
The 5th step, record the balance carried down on the opposite side as the balance brought down.
Record the balance?
Record the balance carried down on the opposite side. You record it where? On the opposite side. It will be recorded as what? As balance what? Brought down. Now, I'll show you what that means. No worry. All these steps.
Record the balance carried down on the opposite side?
Yes.
That's it. Okay.
Yes. We are good?
Yeah.
Okay. So now, see what was happening here. So they had to total up everything, both on the debit side and on the credit side. And after totaling up, see that the biggest amount that is happening here is that, what is happening is that it is balancing up, okay? This amount and this other amount, it's just equal. So there is no difference carried down. I'll show you what is happening. So we say that if the account is equal, on the debit side, when you sum up, the amount is equal on the debit and credit. We say the account is balancing itself off. Okay? So there is no need of carrying the balance carried down or balance brought down because the account is able to balance itself off.
Okay.
Now, let's balance off this one. For night. So we can add on the debit side. Add on the debit side so that you understand what I'm bringing here.
Add on that one. 1, 8, 482.
482? That's the biggest amount. Oh, that's from the debit side. Then on the credit side, we just have 158. So we'll record the biggest amount, both sides. This is what I meant.
Okay.
Got it? What is the second step saying? After balancing off, after recording both sides, the biggest amount?
Recording both sides. Subtract smaller amount from the big amount.
Yes. So deduct 482 minus 158.
324. It's 324.
324?
Yeah.
Yes. So that amount, you will call it as the balance carried down. Now, the date will be the last day of the month in question. This is August. August ends at 31st. 31st August. Then you write balance carried down 324. You got it?
Okay.
What is the next step saying? After you have recorded the balance carried down on the other side?
Record the balance carried down on the opposite side.
With the new, now the next month, okay, because this will be the new period. After August is September. So the date you put 1 what? September 1.
Okay.
You get, that will be the date. Next month, and then the details will be balanced, brought down, just down below this total, and you record the 324. This is how you balance off the account.
Okay.
You got it? Very easy to balance off, isn't it?
Yeah, it seems easier than the previous one, the balance sheet.
No, the thing is that as we move on, it gets simpler because the explanation is revolving again and again.
Okay.
Yeah, don't worry, it will be very simple and simpler. You know? Any question?
Yes, sir.
There is no question. Then we can proceed. We have learned how to balance off the account. That's a major message. That's the main thing that we take here, the take-home message.
Okay.
You've seen there. Yeah, they have written now balance carried down, balance brought down. This is the same thing that I've already explained. So I've gone basically before my slides. Any question?
Yes, sir.
Now.
No, I mean like, no, sir, we can continue.
Oh, okay. Now look. The major thing that you should always concentrate on is the position of the balance brought down. Is it on the debit side or on the credit side? If the balance brought down is on it shall always be on the opposite side. They can never sit on the same side, these two. Okay, don't do that. So if the balance brought down is on the debit side, you say that the account has a debit balance. Okay?
Okay.
But if the balance brought down is on the credit side, you say that the account has a credit balance. In a broader sense, you know what this means? We go ahead. This means that this account, when you go to the trial balance, it will be on the debit side.
Okay.
And which is true. You were selling to someone on credit. These are receivables. Receivables are assets. Assets are debited, isn't it?
Yeah.
On the trial balance. Exactly. Making sense. Right?
Yeah.
Yeah. So this is what that means. Then if you go to what is this? You go to the other persons now, or we go to the other situations. Sometimes you may have this balance carried down on the credit side or on the debit side. It means that now the balance brought down will be on the debit side, will be on the credit side, right? If the carried down is this side, then the brought down will be this side. So you say that this account has got a what? A credit balancing.
Okay.
That is what happens. Any question?
No, sir.
But again, if the account does not have the balance brought down, like where you have no difference, like where when you sum the credit side and the debit side, they are just the same, like they are equal, then that account has no balance brought down. For that reason, it shall not go in the trial balance. It will have no an effect. It will never have any effect on the trial balance because it cancels itself out. Every account that balances itself out, it doesn't go in the trial balance.
Okay.
Because what goes in the trial balance are these balances brought down. Okay? You have the balance brought down for cash account. That's the balance that you find that is usually labeled cash on the trial balance. Is the balance brought down after balancing of the account, you get? When you go to assets, all the assets, like they had to enter transaction one by one, and at the end of the period, they balanced off the account. And then it is that final figure that they put there. So if it's the final figure, for example, for the sales, they will record all the sales that they have made in the sales account. Then they balance it off at the end of the period. Usually the sales account will have a credit balance. Then the credit balance, it means that the sales account will have a credit balance on the trial balance as well. Okay? That's why the sales account or revenue is always credited. Revenue is credited on the trial balance. Is that clear? I can even take this opportunity to speak in advance that when you got the trial balance, the following are the common things that you do what? You debit. The things that are debited on the trial balance or the elements. It's Alex. You get for it to be easy for you to remember, I came up with what's the mnemonic Alex. Okay, what is Alex?
Okay.
Number one, assets, losses, assets and losses and expenses. These are debited. These are the only thing that you debit on the trial balance. The asset, all assets are debited. All losses, okay, losses are debited, and all expenses have a debit entry. You will see that even if you try to balance off the expenses, they will always have a debit balance. So this will not be very strange now you understand how to balance off the accounts. So it will not be very strange. You will know the reason why they should always have a debit balance. Why? Because when you got the trial balance, they sit on the debit side as well. But we have explained why they should sit on the debit side, isn't it?
Assets, losses, and expenses.
Yes. Now, credit. What do you credit? You credit all the incomes. You credit all the what? All the revenue.
Income. Oh, income.
Or sales. What else do you credit? Gains, liabilities. And capital. So capital, liabilities, revenue, and income, these are credited on the trial balance. Are we good? If you want even using this now, you know what you can do if you have time, whenever you can manage, you can just pick any trial balance, even online, anywhere, and try to analyze. You will see that what will be on the elements that will be on the debit side of the trial balance are assets, losses, and the expenses only. Then, just for the sake of understanding, then what will be on the credit are the incomes, such as maybe income received, what commissions received, chan, and the revenue, which is sales, and liabilities and capital. Those are the only elements that you will see on the other side as well.
Okay.
The key message to get is that drawings are never expenses for the business. That's very important to learn. Okay.
Okay.
The drawings are never expenses to the business. Yeah. There is this one that the credit account, this one that has got a credit balance for William. You've seen it, which is basically the same thing I've communicated already about. So it's nothing strange. So basically, That's what happens.